Hey everyone, welcome back to the Crypto Code. Today we're breaking down whether this Bitcoin dip is a real buying opportunity, because right now sentiment is ugly, fear is high, and the market feels confusing. But when you zoom out, the data actually paints a much clearer picture than most people realize. Let's talk about it. Before we jump into today's topic, we want to remind you that here at the Crypto Code, our goal is to provide you with the top news, research, and tips when it comes to finding projects with huge profit potential. Stay to the end of this video and learn how you can earn $10 in Bitcoin and a free weekly trade alert just for attending one of our free workshops to learn more about who we are and what we do. No purchase needed. Our trade alerts have a 93% win rate, so make sure you take advantage of this free alert. Remember, I am not a financial advisor. This is not financial advice. So do your own research before you make any crypto trades. Okay, so let's start with what institutions are really doing, because this might surprise you. Even though Bitcoin has pulled back hard, institutional interest hasn't gone away at all. In fact, big investors are requesting more research, more education, more guidance. But they're not pulling the trigger yet. Trading volumes are low, and most of them are sitting on their hands, waiting for cleaner signals before deploying fresh capital. So interest is high, conviction is low. And what signals are they watching? Well, institutions typically judge Bitcoin using three major indicators. The first one is global liquidity, which is basically the macro weather system that Bitcoin trades under. Right now, liquidity is tightening because massive AI and hyperscaler companies are borrowing a ton of money, and Bitcoin miners are involved in that build-out. Many miners have been selling Bitcoin to fund their AI infrastructure, and that's added real selling pressure. So on this front, liquidity is looking mixed to slightly bearish. The second signal is leverage in the crypto market, and this one is actually bullish. Leverage recently got flushed out brutally. Funding rates reset, billions in positions were liquidated, and overly optimistic traders were wiped clean. Historically, when the leverage market resets this hard, Bitcoin tends to stabilize and recover afterward. So this is the one green light in the system. The third signal is on-chain activity, and that one isn't great right now. Transaction activity, fees, and address growth have all cooled off. Not disastrous, but definitely soft. So this is the red light. So institutions are staring at one green, one yellow, and one red. That explains the hesitation. But even with mixed signals, many are watching the same key price level as a potential re-entry zone. Here's the reasoning. Last cycle, we saw an 80% crash. Since then, Bitcoin's volatility has been cut roughly in half, so instead of an 80% correction, a normal pullback today might look closer to 40%. A 40% decline from this cycle's peak puts Bitcoin right around $77,000 to $78,000. And that level is extremely important. It was the breakout zone after the election. It was retested earlier this year, and there's a ton of technical support stacked around it. That's why many institutional desks are watching the high $70,000 range as a prime risk-reward area. Below that, you have the 200-week moving average around $55,000. Possible, but most pros see that as a much lower probability scenario. Now, how do professionals actually buy dips? The answer is yes, they buy dips, but they do it slowly. They don't try to nail the exact bottom. They scale in, dollar cost average, and build positions over time. Retail investors don't have committees or risk managers slowing them down, so ironically, retail usually has more flexibility. So the real question is this: what sparks the next move up? And there are two big catalysts to watch. First, clear evidence that AI investments are paying off, because if corporate AI spending begins showing real returns, it eases some of the liquidity pressure. And second, a cleaner path toward Fed rate cuts, which would reopen the liquidity taps and historically helps Bitcoin rally. So right now we're in that classic late-stage fear environment. Leverage cleared out, miners selling to raise cash, institutions waiting, and on-chain activity cooling off. Historically, moments that feel like this tend to become opportunity zones, not cycle tops. Thanks for watching the Crypto Code. If you found this video helpful, please like, subscribe, and hit the notification bell for more crypto insights. Let me know your thoughts on today's video in the comments below. You can also check out what we do here at the Crypto Code by registering for one of our free workshops, where we show you how we and our students profit in crypto, no matter if the markets are up or down. If you register for the workshop, you also get access to a free weekly trade alert. Attend our free workshop, take a short quiz at the end, and we will send you $10 in Bitcoin. No purchase needed. We have already given away hundreds of thousands of dollars worth of Bitcoin just this year alone. Just look for the link in the description of this video to register for the workshop. It will be worth your time. Our public trade record currently has a 93% win rate, and you can view it here. Best of luck with your investments, and remember to stay informed and stay safe in the crypto world. See you next time.